Things are happening here. And we are good. We are good. So, good afternoon, Crystal. How are you today?
I am fantastic, Jevon. I've missed you.
Well, thank you much, ma'am. I've missed you too. We have had quite the adventures in the last few weeks, have we not?
Yes, we have. I've been crazy busy, my kid thing. And
Yeah.
um, I have to tell you, this is off air, but my niece left to go to Egypt. And I cannot tell you the drama that took place for 4 days before she actually got
Oh,
on a plane. I
wow.
was wore out. It was deep. It was
Wow.
I was at the
Wow.
airport. I was at the airport every day for 4 days until she flew out on
Oh,
August 3rd.
oh my goodness.
Yeah.
What were you doing at the
So
airport before was she flying standby?
no, she was flying to Egypt, and so they changed the COVID testing that had to be done,
Oh,
and
I
she had a
see.
COVID test, but it didn't have this QR code,
Okay.
and
Okay.
so we had to postpone the flight that she was supposed to take on the Tuesday, which was
Hmm.
August 3rd.
Oh my.
And then we had to wait to and then we had to try it the next day, and it still didn't have the right code that they wanted.
Oh my
And
gosh.
then we had to postpone to the Thursday, Friday. They'd have one flying out on Friday. Had to try all over the city trying to get this right code. Spent lots of money. She was in hotels for 3 days. It was quite
That sounds like a
interesting, and
mess.
it was a mess. And so I'm recuperating from that this week.
Well, at least you have great driving skills now, and you know the city probably better than anybody.
I done navigated through the airport and all the crazy traffic going through the airport, and construction,
Oh my gosh.
and then
Oh,
wasn't
you froze on
on the
me.
Friday when she was leaving. And okay, don't know what happened. I leave to go to the airport early, and they had been a bomb threat at Terminal 5, so they
Nice.
shut down everything. And I was in trying to get into the airport for an hour and a half. Just some. It was deep. That's
So,
all I can say.
yeah, that sounds like some spicy sauce there.
It
That's something
was
else.
spicy sauce.
Spicy
So, how
sauce.
was your trip? Before we get on with our topics, how was your trip?
My trip was fantastic. While you were worrying and trying to figure things out, I was relaxing and
Oh,
just
good.
doing a little bit of work and meeting up with my friends and family and eating salmon and just um, enjoying the great state of Alaska as only so many people can. It was absolutely fabulous. I would encourage everyone to go. I would say if you want to take the cruise, that's fine, but if you want to fly into Anchorage and take a car and go up to Denali and then go down south and maybe catch some fishing, some animals. We saw Dall sheep, moose. I didn't see any whales, but I know where they are, and we had a great time.
Now,
A
is this the
great time.
best time to go to Alaska? The weather was
I think it is.
comparable.
Yeah, I think it is. The last 2 to 3 weeks. So that would be anytime in June. Anytime in June or July is great, and
Okay.
probably the first part of August. We always had snow um, for the Halloween. I said snow for
Hmm.
Halloween, but we
Hmm.
always had a beautiful start of the school year. So this is, it's tough to go during the school year for a lot of us because we have children to take care of them. But if
Hmm.
you can get there right before the school year, a month before the school year, it's beautiful. The sun's out for a long time, and you will love your life. If you get there a little bit closer to July, into that July thing, so the middle to end of July, it's still beautiful. It's still warm enough to get the sun, but you can also float Campbell Creek, which is a good thing for those of us that like to take our beverages with us when we
Oh,
float.
so That sounds like you and I, far as weather goes. I was born and raised in Buffalo, New York. That was the
Yes.
exact. That would be the exact same advice I would give people going to Buffalo. Do not come until June, late June, July, and
Yeah.
maybe
Yes.
not even June, maybe July, August, and then the
Yes.
very first week of September. After that,
Exactly.
don't come to Buffalo. So it seems
Yes.
like we had similar
I think we did. I think we did.
winters.
Yep. I think we did. I think we did. Yeah.
Well, that's cool.
Yeah.
I'm glad you enjoyed it and your family is good. And
They
I'm
are.
glad to
Thank
have
you
you
very
back.
much.
And
Yeah, and
I have to.
they sent me back with a little bit of a gift, which is very cool. So I'm going to take care of that. And my dad has a hot tub,
Oh,
and so
okay.
that was very nice to hang out. I haven't hung out in hot tubs in I don't know how long, so that was cool. But
Okay.
let's get
All
started.
right.
Um,
Okay. Let's do that.
so, welcome everyone to Conversations on the Patio. I am Jevon Thomas, a registered retirement plan advisor, and my co host is Crystal Mitchell, and I'm going to read her bio. So, without further ado, here's Crystal, and thank you very much. Here we go. Um, that's not okay. Crystal Mitchell is a business coach and consultant. She is the CEO of Mitchell Business Solutions. She's the co-director of Recycling Black Dollars. She's also the co-host of another business show called The Business Zone with Crystal and Gilbert. And it says here a weekly online radio show. I like to refer to that as the other show. She is an instructor at Mount San Antonio Community College. She's also a certified network for teaching entrepreneurship instructor, and last but not least, a QuickBooks Pro Advisor, financial strategist. Welcome, Crystal Mitchell, and again, thank you for being on the show.
Oh, you're so welcome. And thank you for that introduction. I'm glad to be here.
Yeah. So the thing I want to
Hmm.
talk about today is a couple of things, and I was wondering how I was going to actually wrap this all together, because it's actually a discussion of what we call dollar cost averaging. And I think
Hmm.
I've mentioned a couple of times before that that's one of it can be one of the differentiators between investing in a company sponsored retirement plan like a 401k or a SEP IRA or even a 403b, something like that, that versus outside investing, where with regard
Mm.
to a retirement plan, we have usually a beginning, which usually means someone hopefully fairly young, and then they put their money in, and when they get older and they're ready to retire, they pull that money out. Of course, many of the folks that
Hmm.
we talk to have pulled that money out early so they can start another dream, and that's fine. It still works the same way. So there's that.
Hmm.
And then there's the regular retirement where you actually hire someone to help you invest your money, right? So one is a company benefit, and then one is where
Hmm.
you hire someone to help you invest your money. And your goals can be almost the same. They look the same because they're using pretty much the same tools, but we're using them in different ways, right? So
Hmm.
when we talk about things that are going on in our economy today, as you know, I typically have lots of things to talk about that, but I want to play a little game with you, and you let me know what you're thinking. Is that okay?
Sure.
Okay,
Works for
so
me.
how do you pronounce the capital of Louisiana? Do you say Nolens or New Orleans?
I say New Orleans.
New Orleans. Okay. A lot of people too, but unfortunately, the capital of Louisiana is Baton Rouge, right? And
Oh.
yeah, right. And people
Mm.
always get trapped in that. So you're not alone. People get trapped in that a lot. And
Okay.
what I find is that most people, when they look at a retirement plan, they focus on the wrong thing, right? So
Mm.
now, when we take a look at our economy right now, right here, and I just want to clarify right here, right now, August
Hmm.
16th, so let's not get this twisted. We've had an economy that's been fairly robust with regard to stock prices. It's been a pretty good market for folks that are in the market. So
Hmm.
if you had the presence of mind to get into the market within the last Well, hopefully, let's say it a year or so ago, then your monies are doing quite well.
Mm-hmm.
We take a look at what's going on now. They're doing fairly well. We've got a couple of bills in the mix, but for all intensive purposes, they're doing pretty well. Okay. The fear then is, how does dollar cost averaging affect that? Because as you know, dollar cost averaging means we're going to put money in on a regular basis. We're going to put it in every 2 weeks or every month, every time we get paid, right? We're going to put
Mm-hmm.
that money in. If this
Mm-hmm.
were outside the plan, maybe you would put that money in once a month or until you'd moved all your money in. Now, why do you want to do that? Well, you want to do that because we cannot affect the market, right? We can't decide when to get in and when to get out. We cannot do that. Anybody that can tell you when the market's going to go up and when the market is going down, you should run from, because we just don't
Mm.
know. If I knew when the market was going to go up or down, I would not be doing this show. I would be doing something totally different. Right? So,
Mm-hmm.
dollar cost averaging, though, gives us the opportunity to buy on a regular basis, but since the market goes up and down, there's a very good chance that we're going to buy sometimes when the market is up, sometimes when the market is down. Why is that good? Well, as you know, our economy, even though it's generally been going up, and I could say that for the last, or since the crash of 29, it's generally been going up, going up. There's some downward parts in there. Some would say
Mm-hmm.
there are more downward parts than there are um, markets going up. So the market's going down more than it's going up, still in an upward trend. We'll get into that later or some other show. But the market goes up and down. Okay. So, what you want to do if you're in a retirement plan, that is, you start at one end and you're going to sell at another, is you want to make sure that when you get to the end, that you've bought as many shares as possible, because you're going to turn those shares in for cash. And hopefully, you and your financial advisor have talked about how you're going to turn that cash into an income stream after you leave work. Does that make sense? So the
Mm-hmm.
step is, we have a lot of shares that we've bought at a price lower than the price we're going to sell them. Are you with me?
Mm-hmm.
So that's why we
Yes.
say, it makes sense. So that's why we say in
Mm-hmm.
year 5, year 10, year 15, it really doesn't matter what the market is doing. You just need to put that money in. You with me?
Okay.
All right. So we need to have a well
And
diversified
so
portfolio.
the market is always up and down anyway, right? So especially if
Right.
we're looking at our retirement, we're not day trading, right? We
Right.
we
We're not day
are
trading.
we're working for the long term, right?
That's right. Yep.
Yeah. Okay.
And that's a very good point that you just brought out there. What is long term? If I go up to a person A and I say, "What's long term to you?" They'll say, "That means I'm going to be in the market for a long time." If I go up to person B and say, "What does long term mean?" That means I'm going to be in the market for a long time, but I'm going to take advantage of dollar cost averaging, and I'm going to take advantage of rebalancing my portfolio, making sure I'm at the right level of risk, because I know that when I decide to get out of the market, I want to make sure that I can take all of the shares that I have and I want to sell them and I want some money and I'm going to do something with that money. Does that make sense?
Okay.
You're with
Mm-hmm.
me? Okay. So
Did you
if
freeze or
I,
did I freeze?
I think you froze.
I am. I
Yeah,
froze.
you
Hmm.
froze for a minute.
Okay.
I'm talking, so I don't know when I freeze. I just keep talking.
Well, I keep hearing you, so it's okay.
I'm pretty
Technology.
yeah, thank you. I appreciate that, because um I'm very passionate about this, because I
Mm-hmm.
find that investors focus on the wrong thing and that gets them jacked up. So right now, everyone's focused on inflation. And that's a tough thing. We don't know what's going to happen when that trade bill passes. We don't even know if it is going to pass, right? The folks in the House and the Senate have their agenda. So, and this
Mm-hmm.
is why I thought about this show. What do I do now as an investor in my retirement plan when I've got this sort of Damocles inflation thing hanging over my head that I know is not going to be good for me? How do
Right.
I manage my portfolio? And as a retirement plan advisor, I'm saying to my clients, stick to your knitting, figure out what your risk tolerance is, dollar cost average, keep putting that money in, and stay the course, as some folks have said that I shouldn't mention. Stay the course. Keep doing what you're doing. Go back to your knitting. Go back to the basics. Take the questionnaire. Figure out what your risk tolerance is. Keep putting the money in on a regular basis and hope that sometimes you're going to buy high, sometimes you're going to buy low. But when you get to the end of the period, that is when you turn 65 or so, you're going to have a pot of shares that you can turn in for a pot of cash. Does that make sense? So
Right.
that's
So
what dollar cost
basically,
averaging does for us.
and so basically, what we're saying is that we shouldn't be panicking, because there are a lot of things going on externally right now that is affecting the stock market. Actually, I would say since, I don't know, since 2008, any little thing can affect the stock market, right?
Hmm?
Yeah,
Very
it's
true.
not just one thing, it's multiple things. The Afghan war, what's going on over there is making some effects. It just depends. So we can't be reactionary to what's externally going on around us. We got basically, what I'm understanding is we have to stay the course, but we have to
Yes.
maintain and balance what we have, but we have to stay the course and don't derail ourselves. Is that what you're saying to us?
That's exactly what I'm saying. And I'm also saying that if you want to take advantage of what's happening in the market or in the world, I think that's fine. I don't have a problem with that. So I don't want to
Mm-hmm.
get letters and phone calls about people saying, well, I need to do X, Y. I don't want to do that. If you have a financial advisor, or if you're a savvy investor, or if you're someone that just likes to run your own investments and you want to do that in the market, I would say if you're going to do that in the company benefit, you're playing the wrong game. Outside of the company benefit,
Mm.
go ahead. You got your own IRA there. You got your own financial advisor. You guys are talking about a strategy, something I don't know about. Fine, do what you got to do. Right. But if you are talking about your
Mm.
company benefit, if you have a company, you've set up a retirement plan inside your company, this is how you want to manage that. You want to stay the
Mm.
course. And the reason
Okay.
because is the rules we're playing a little bit different. It's like baseball and softball. We use similar tools, but we're using them in a different way, right? Make sense? If that's
Mhm.
a sports thing that people
Mhm,
don't.
mhm.
So maybe like Swiffer, I don't know, something that's non-feminine. I need to get off of this topic right now. Anyhow, the point of the matter is that we want to stay the course. Now, we've got the market booming. It's been booming for the last 6 months or 7 months or so. What were we
Mhm.
supposed to be doing then? Because according to dollar cost averaging, we're putting the money in on a regular basis. Those of us that were afraid of the pandemic, right? We didn't know what was going to go. We didn't know if we were going to have a job. We didn't know what to do. And many of my colleagues, they just didn't know if they were going to be able to go to a job or not. For those folks, they put money into the market,
Oh,
right?
really?
Right. So as the market during the last administration, as the market started getting better and better and better, and then all of a sudden the pandemic hit, and we had a small downturn in the economy, but then it started picking up and going better and better and better, and now this administration is going better. But those folks lost out on that growth,
Mm.
right? They lost out on the growth. Now, did they retire or are they still there? If they retired, not so good. If they're still there, some may make the argument, well, if the market crashes and I bought all of these expensive shares, haven't I lost money? Right? And the answer to that is it really depends on you where you are, right? That's why your risk tolerance is so important. That's why you
Mm.
have to determine when you have to determine how you let the market affect you rather than being reactionary to what's going on in the market. Can't be reactionary
Mhm.
to what's on the market. If it's time for you to sell, it's time for you to sell, right? That's why it's so important to get in early. If you get in early, you don't have to take as much risk to get the same return as you would if you got in later, right? If I can start people in their 20s and their 30s, the amount of risk that they have to take versus someone starting in their 40s or their 50s is dramatically less. So the market goes up and down, you really don't care about it because
Right.
you've got money in the market. You've got time to be in the market. Time is your friend. So what do? Well, there's a very good chance that the market's going to go up sometime, right? Since the crash of 29, the market has continued to go up. It hasn't gone up in a straight line. It's always gone up in a jagged fashion.
And down.
Right? Up and down. So dollar cost averaging in the period throughout all those 2-week periods, all those month periods, all those year periods, those decades, dollar cost averaging has helped investors buy at average prices. So the theory is this: if you buy at an average price, that average price is going to be lower than what you sell at when you're 65. That's the theory we're working on. Is that if I buy, even if I buy high here and I buy low here, I've got an average price of somewhere in the middle, right? That average price is going to be lower than the hill, the top. So hopefully I want to retire when the top is high, right? I want to retire on an upturn. But the beauty, you're with me? But the beauty of buying at an average price is, even though the market isn't high or up, because I bought at an average price, that average price is going to be higher than the initial price that I actually bought at, because it's got highs and lows in there. Does that make sense? Right? So
again,
I want to.
There we go.
Okay. Yeah. So I want to, as an investor, I want the best I can do is to buy and sell at an average price. That's the best I can do. And as long as that average price is higher than what I bought, we're in good shape. If I started this back in my 20s, there's a very good chance that a lot of my purchases have been dramatically lower than what I'm selling at.
And at that age, and at that age, you've been sitting down with your advisor numerous of times. I mean, you got decades, right, before it's time for you to technically retire, at least 6 decades. And
maybe.
So you would have helped that individual rebalance it to make sure that they were going in the right direction.
Right. So what rebalancing does is that fixes my risk tolerance, right? That says I'm going to react to the market in such a way that I don't get scared to put my money in. Okay. And we control that with a number of stocks versus bonds in our portfolio. That number of stocks versus bonds controls over 90% of the growth in our portfolio.
That's a lot.
It's a lot, right? So I need to make sure that my risk tolerance is correct. Now, here's the deal. Anecdotally, can I say, if I take more risk in the market, I get more reward? Well, yeah, in general, you do. If you put out more risk, then you should get more reward. I'm going to say you should get. All things point to you getting more reward, right? But I can't handle that. I have a friend now, he cannot handle risk. I have 2 friends. I met one of them up in Anchorage. He is so afraid of risk. I say to him, the market goes up and down, and he says, you can't tell me when it's going to go down. I said, no, I can't. He said, you can't tell me when it's going to go back up. I go, no. So it's very possible that I'll lose money. I go, well, you don't lose till you sell. And he says, that's what you people always say. You don't lose money till you sell. But the truth of the matter is, I look at my portfolio today and I look at my portfolio tomorrow. It's less. I've lost money. I don't like that. It makes me feel bad. Whew. And it doesn't matter that all of my friends who are not investment professionals, it doesn't matter what they say, right? They could say, well, you're young, you have some time, it'll come back. He doesn't want to hear that. He wants to hear, I put my money in today and tomorrow it's worth more, right? And I know, I have someone very close and dear to me who was very much the same. My ex-girlfriend, Gail, she would say, look, I put my money in, it went down, I'm taking my money out. So why should I do that? I'd rather pay off a credit card. She is that kind of person, right? She said I could give my money to my sister and lose it. She was not into the market.
But that's the same thing. I mean, when you look if you put that in a different text context, right? You buy a car, right? You go out and buy a Mercedes. Even a Mercedes loses value, right?
Yes.
As it gets older. So you may have spent $100,000 on this vehicle because you had to
only
have
Crystal can buy $100,000 vehicles. I just want to say that I cannot afford $100,000 vehicle. Crystal can. She worked through the whole vacation thing, so there you go. All right, fine. Rub that in.
But whatever
Thank you very much.
whatever vehicle you buy it, and what's the old adage? The minute you drive off the lot, it's already lost value, right?
Yes.
Your house, you buy your house. Your hope and goal is that it's going to go up. It's going to elevate in value, right? But we also don't know that can be artificially manipulated. Like right now, the housing prices have been artificially manipulated because of the overbidding and so forth and so on. A person's house really is not, if it was $400,000 last year and it's now $1 million, we know that is not, if the market was to crash, your house is going back to below or where it was or below where it was, right? And we could be in for a housing crash. But we make those investments.
Yes.
Right?
Yeah.
And you never know. Our hope is that our house is going to elevate, and that's a good investment. But that's not, something could happen like 2008, and all of a sudden you lose all the value in your house. So to say that no one's telling you to go out and be super risky with your portfolio, but everything has that capacity to lose value.
Yes, and it's interesting how we use the word worth and value and the amount I can get for it, right? And those are very emotional terms that we're talking about there. But to your point, we have to consider that, right? Every car that we buy depreciates. As soon as you take it off the lot, it's no longer worth what you paid for it. And we buy those. And that's one of the reasons why some people only lease cars. Because why buy a depreciating asset? You might as well lease it, and especially if you have a business, and use it and write it off your taxes, right?
Right.
That lease amount. So it's a very good point. We're used to making those decisions. You buy I don't know, you could buy a mixer. Chances you're going to sell your mixer for the same price that you sold your mixer for 5 years later, it's pretty slim.
Yeah.
Pretty slim. You've done that. So why is it that we're so afraid of the money going down in the market? And I think part of it is because we can't see it. We can't hold it and grasp it. And I don't know what that is, but it is very difficult to get folks to realize, hey, if I dollar cost average in good times and in bad times, I'm going to end up buying at a average price, and that price is going to be hopefully dramatically lower than what I actually bought all of that stuff for. So if I dollar cost average in good times and dollar cost average in bad times, I'm buying at an average price, and that average price is going to be, higher than what I actually bought at.
Exactly. And you also have some control because it is a retirement plan, right? So you might have to push your plans off a little further out if if the market or something has changed and you were saying, I'm going to retire in this time, and if it don't look like that's a good idea, and you still in your health, and as you have said, show after show after show, we're not making these decisions um in the now, right? We're
Right.
coming back and reevaluating every 6 months to a year or so.
Sure.
So we could look
Yay,
out
you
to the
remembered.
I did. And we would look out for the future and say, you know what, if I'm like 2 or 4 quarters away from retiring, and maybe my portfolio is not where I need it to be based upon how I want to live, maybe I might put that off a little longer.
Maybe.
Or maybe I may
Maybe.
have to make some maybe, or I may have to make some other arrangements, or some other plans, but you have enough time to react. It's not like,
Yes.
right?
Yes, that's correct. And you have to be careful with that. I remember a client when I lived up in Seattle who had a relative that retired um, with X amount of dollars. And so they wanted to be like their relative and retire with the same amount of money.
Mm-hmm.
And I said to this client, you're almost there. Why push it? You've got enough money to retire
Mm-hmm.
upon. Of course, I never met anybody
Mm-hmm.
with too much money, but you've got enough to retire upon. Take it and run, and be very conservative because you don't want to lose it. How much longer do you want to work? Well, I just want to work until I get to X point, because that way we'll have the same amount of money. He'll have his 8 million. I'll have my 8 million. We'll be happy. Houses were sold and things like that. So he
Mm-hmm.
waited,
Mm-hmm.
and then the market crashed, and he could have been $1 million less, but when the market crashed, his 401k took a hit, so now he's like $3 to $4 million less. So then he had to wait until that market came back in order for us to get there. We all know in 2010, the S&P returned over 16% for some people. So, well, you want to wait that long, or but those are the kinds of decisions that you can make when you're sitting on some money. But it's tough to make that decision when you don't have very much money to begin with, or when you don't have that concept of, hey, we're going to dollar cost average through this thing so that we can buy at an average price, so that when we sell, that price is higher than the average price that we bought at. That's what we want. So, does that make sense?
Yeah, that makes a lot of sense. It's still everybody's retirement needs are different. And I don't know, comparing my retirement needs with your retirement needs wouldn't have been a good idea. Because
Probably not.
everybody's needs are different.
Yes.
And lifestyles are different. And so I think you have to, and I think it's very important to listen to your advisor.
It really is. You're a team. You want to work this thing together. And I love that approach. There are some folks, some advisors that say, hey, I'll take care of it. You just let me have your money and I will do what I need to do. All you have to do is make the money and I'll manage it for you. I don't really like that. Right. And I've had to turn away some clients because of that, because I want to be a team with my client. Right.
Yeah.
That's just me. It's just me. There are lots of clients out there who say, well, what does that mean? That means that we're going to talk about the decisions that we make, and we are going to talk about decisions that we make, so that you can have an educated life and you can make decisions and you understand what's going on. Because the last thing in the world is to have someone come up to you and say, where's my money? Well, it's not there. You were managing it. Where'd it go? Have you got it? No, I don't have your money. Well, you need to find it. Right? I gave it to you. Where it at? Right? We don't want to have that. We don't want to have that conversation. So let's do this together. And there's so many things that we have to do that way. Once we become adults. I mean, when I was a kid, I could always go up to my mother and say, "What's for dinner?"
Right.
She'd say, "Whatever I put on the table, that's what we're having." Okay, we're gonna trust that. That's fine.
But even from my profession as in accounting and bookkeeping, I'm one that when I work with my clients, I want them to know what I'm doing. A lot of people like just my accountant has it. I'm good with that, but I don't want to be that one person, right? I don't want you not to know what I'm doing, because when someone is, it all comes down to you. It's still about you, right? And so you as my client, you need to understand where I am, and we're a team. That's exactly what you're saying. We're a team. And so come in year tax season, we don't want you going, oh, wow, I made that much money. I didn't know I made that much money. What does that mean? And I want you to know all along where you are. Again, it's that meeting several times throughout the year to make sure we understand that you're on track for the end of the year and for for what the tax season is going to look like. No surprises. And I think that's what's so important. People don't understand when we talk about a team. You don't want to turn all of that over to an individual. You both need to be well aware so that there are no surprises come time for retirement or come time to pay taxes at the end of the year. Everybody needs to know exactly what's going to happen. No cliffhangers.
Exactly. So I think it's this time in our little journey where number one, I should read your bio again. And then number two, we should talk about don't be that guy. So are you ready?
Yeah, I am.
So, okay, everyone. I'd like to introduce to you my what are we? Sponsor? What are we? Host? My co-host. Yes. A co-host for today's show. Crystal Mitchell, business consultant and coach. She's a CEO of Mitchell Business Solutions, co-director of Recycling Black Dollars, co-host of the Business Zone, that other radio show, instructor at Mount San Antonio Community College, certified network for teaching entrepreneurship instructor, and a QuickBooks Pro Advisor financial strategist. Thank you, Crystal, for being on the show. Let's talk about.
And who are you?
Oh, that's true. I'm Jevon Thomas. I'm a registered advisor and I specialize in retirement plans, 401ks, 403bs, that kind of thing, and non-qualified plans. That's what I do. Okay. So, the don't be that guy thing. Any ideas?
Well, I think not appeared. Met with your advisor.
Oh, we didn't hear that. You froze on us.
Do you have?
I do have an idea, and I'm going to say that no matter, don't be the guy that gets caught up, or gal that gets caught up in a situation where they're following the trends and they don't understand what's going on. So, for example, we take a look at the market going up and the market going down, and we get afraid of what's happening. We get afraid of the beast. So you have to understand how the beast works. You don't have to understand, if you're a driving person, you don't have to understand how an internal engine works, but you do have to understand that you need to put oil and gas in the car, right? So at a very basic level, you have to have some understanding of what's going on. And I'm just going to say right here and now, don't get yourself in a position where you don't have an idea as to what's going on. Don't do that. Don't be that guy, right? Don't be the guy that says, I don't understand this. I don't want to understand this. And I'm going to allow this person to take care of it, because even though that person may have the best intentions and they may be able to guide you the best, even better than I can, there are going to be some times when you are befuddled and some decisions made that you're not going to understand, and you're going to be in a situation where you're hurt, you're not feeling confident, and that's a very difficult place to make an investment decision. Very difficult place for you to be. So get a little bit of knowledge. And the last but not least is find someone you can connect with when it comes to being your advisor, especially a financial advisor. We've got all kinds out here. Most of us are pushing for a very diverse group, troop, camp of financial advisors, so that if you roll one day one way, they roll with you, right? Not every financial advisor is great for everybody else. So find one that you connect with, become that team member, and go forth.
I think that's excellent. And I think also, sometimes we as people, our human nature is to get paralyzed in our own fears. And I don't know, I think some people have an aversion to, as easy as it is to acquire information today, much easier than it was 15, 20, 30 years ago. We still get stuck in what somebody else's experience is, right? We heard about somebody, this happened to them.
Yes.
And so inevitably it's going to happen to me. But you don't know this because you don't know what all the dynamics were for that particular person. So it's, each one of us have our own individual financial journeys to go on. But there is enough information out there that you can become knowledgeable in. And if something you don't understand, then of course you have your advisors, your financial advisors there. But I think we as people should utilize the resources that are out there for us.
Yeah, and I think you're absolutely spot on. Absolutely spot on. We are trapped in the fears of situations that may or may not be the same as ours, and most likely are different from ours. I think there's also a fear out there that suggests I don't know enough in order to make a good decision. And I think in many situations, that's just not the case. In many situations, basic understanding and a little bit of experience, you can make a good decision. You just have to put that in your mind. You can make a good decision. Now, if you had more knowledge, would you make a better decision? Not necessarily. I'll just say that right out. When it comes to retirement plans and money, not necessarily. Based on your situation, where you are and who you are, there's a very good chance, depending on who you are, that you're making pretty much the best situation, the best decision that you can with the information that you have, and that's the best decision you can make. Like I said, should you put gas in the car? Well, do you need to know how an internal combustion engine works? Not really. But you can drive the car pretty well without knowing how that electrical thing works or how that computer works, right? Pretty well. So, I mean, you don't need, because in most situations, we're not talking about building the car, we're talking about driving the car.
Right, exactly. But you do have to have the basic knowledge of driving a car.
Yeah,
so,
again, you got to know when to put the gas in. Where's the gas go? Where's the oil go? Is that the sound of a car? If it's going clunky, maybe you should get some help. And then, then we need to do some things to get educated and what have you, or take your male friend or relative with you. So
yeah, exactly.
That's a different situation. Yeah. You're not always in that. So when it comes to your retirement plan, most people have enough information to make a good decision. They don't want to because there's that fear that you were talking about. And that's just the way that it is. Where our world has shifted to DIY, which means I don't know everything. I just know a little bit.
I like
sometimes
that.
DIY works.
Sometimes. But we have this fantastic little machine right here that's always at our fingertips, that if you're confused about something, you can always Google it and then run that information by someone that you really trust to make sure that it applies to you.
Yes.
Because that's generic, but now you have to find out if that actually applies to you. And I think that's we're in an amazing situation right now. Because I will tell you this, Jevon, when I was in corporate America, and I work for companies in our financial, our 401k. You got the cursory information about your 401k, and you're like, okay. I'm in my 20s. That's gonna be a long time from now. Never even look back at it, right? But as you get closer and closer, but a lot of that information, and I worked in the financial industry, financial planning industry, but a lot of that information was like, shoo, over my head.
Yeah. Yeah.
And
Yeah.
nowadays, you can get a feed about retirement that comes through your Google feed on a daily basis and give you more information than you had, say, 20, 30 years ago.
Yeah. And I think the strange thing to me, when I'm looking at the people that I used to communicate with 18, 19 years ago versus the people that I'm communicating with now, they have the same questions. I've been saying the same thing for the last 20 years. So the people that I said these same things to for the last 20 years ago, they're getting the same education as these folks do. So even though you can get more information, it doesn't necessarily mean that you need all that information in order to make a good decision.
Right, exactly.
Right. And so sometimes that there's an information overload. Newspapers need to sell things, wires need to sell things, companies need to do things, what have you. But too much information just muddies your pack. Now, how do you know when you have too much information? Usually you don't know for yourself. Usually you know for someone else. Usually you know that that person has too much information. Usually you don't know when you have too much information to make a good decision.
Too much information. Information overload.
It's always easier to fix somebody else's life, right?
Right, exactly.
So I just want to say again that most people have the information. You said they can get it. And I love what you said. Run it by someone that you trust, that you can connect with, and you can become a team member with, and see what they say. Do that. Your neighbors, I wouldn't qualify your neighbors and your relatives as those people. I wouldn't do that. That's why we have the show here. Okay.
Yes, exactly.
So I think it's about time for our show to come to an end. Anything else that you'd like to say?
No, been great. I like the fact though, investing in, if we're going to recap what we talked about, investing in a turbulent time. We still can't operate in fear. We have to operate with knowledge and information. And so if you do have concerns right now, then reach out to your retirement planner or your financial advisor, or Mr. Jevon here can become your that guy right over there. He's good. And get that information. But don't just sit there and panic and then wait too late. So there is a lot of information. There's a lot of stuff going on in our world right now that has major implications on our finances, on the economy, and all of those things. But these individuals, they are studying this. This is their job. This is what they do. So they stay on top of the information that is pertinent to their clients in the moment. So reach out to them. They can help you out. So as you said, with all that excess information that you have coming at you, and you're watching the news, and people you got information coming from here, from all over the place, right?
Yeah.
like an airline pilot. So reach out to them.
Yes, exactly.
To help them clarify it for you.
Yeah. Don't be afraid. That's never a good place to make a decision. Okay. Well, Crystal, it has been great chatting with you. Thank you for being the co-host. We're at that time where our show should come to an end. This has been Conversations on the Patio with Crystal and Jevon, and we will be back here next Monday at 1:00 to have another show. And any last words?
No,
we'll see you then.
That's it. Have a great weekend, guys. and a great
Bye
week.
bye now.
Bye bye.